It's 6 in the morning, and Ryan is already awake. Two monitors glowing in a dark room, coffee going cold beside the keyboard, one hand on the mouse, hunting for the trade that's going to change his life. Across town, Sam is asleep, and Sam is the one who's going to win. Here's the strange part. Ryan is about to work harder at building wealth than almost anyone you know. He'll learn every candlestick pattern, memorize every indicator, pour thousands of hours into those two screens, and the math is quietly betting against him the whole time. Sam, who's going to do almost nothing, is the favorite. My name is Nick, and I've spent an unreasonable amount of time watching people confuse being busy with getting ahead. So if you've ever wondered whether day trading is a real path to wealth or just an elaborate way to donate money to strangers, stick around because today we're running the full numbers on both, and the gap at the finish line is going to surprise you. Let's keep this honest because these comparisons are usually rigged. Ryan and Sam are both 28. They both make $55,000 a year. They both have $30,000 saved. Same city, same rent, same starting line. The only thing that's different is what they do with that 30 grand, and more importantly, what they do with their evenings. Ryan reads that day trading is how ordinary people escape the 9 to 5. So he takes his $30,000, buys a $1,500 course, sets up two monitors, and starts trading before work, during his lunch break, and late into the night. Sam reads that almost nobody beats the market, shrugs, and drops his $30,000 into a total market index fund. He sets up an automatic $200 deposit every month and basically forgets the account exists. On day one, these two lives could not look more different. Ryan has a setup, charts glowing on two screens, a watch list, a journal, and a Discord server full of guys with rocket emojis in their usernames. When his friends ask what he's up to, he gets to say the words "I trade." People lean in. It sounds like a skill. And every time he closes a trade in the green, the app throws a little burst of confetti across the screen, and something in his brain lights up like a slot machine paying out. That feeling is the real product. Sam has a confirmation email. That's it. When his friends ask what he's investing in, he says an index fund and watches their eyes glaze over. Nobody's impressed. There is no rocket emoji for "I bought the whole market and went to bed." Here's the trap this entire video is built around. Ryan's path feels like winning. Sam's path feels like giving up. But feelings and math are two completely different animals. One of these guys is generating activity, the other is generating progress. And your brain is wired to confuse the two because activity is loud and progress is silent. The market doesn't pay you for effort, it pays you for edge, and it charges rent on activity. Keep that in your back pocket because we're about to watch both bills come due. So let's start the clock. Year 1. And I have to be fair because year 1 is where Ryan's story looks incredible. He hits a hot streak. A few tech names run, he catches them, and by spring his $30,000 is up to 38, maybe 40,000. He's beating Sam. He's beating the market. He screenshots a green day, posts it in the group chat, and for a few glorious months, he's living proof that everyone who doubted him was wrong. Meanwhile, Sam's account has crept from 30,000 to about 35, mostly from the market drifting up and his deposits stacking. It's boring, it's slow, and right here, if you froze the tape, you'd swear Ryan made the smarter choice. So remember this moment, because this is the peak. This is the highest Ryan's story ever gets. He just has no way of knowing that yet. To him, it feels like the beginning. This is the part the course sellers screenshot, the Lamborghini in the driveway, the "I quit my job at 28" thumbnail, and it's real for a while. But a coin that lands heads 5 times in a row feels like skill too. It isn't. The traders who win early are actually in the most danger, because the market just taught them the wrong lesson at the worst possible time. By year 3, the coin starts landing tails. The hot streak reverted the way hot streaks do, and Ryan had a brutal stretch where he tried to win back a loss and made it worse. Traders call it revenge trading, and it works about as well as it sounds. There was one Tuesday in March he still thinks about. He was down $400 by lunch, so he doubled his position to win it back fast. Then sat there and watched the thing fall straight through the floor, his hand frozen on the mouse, telling himself out loud that it would bounce. It did not bounce. That one afternoon cost him $1,100 and a week of sleep, and the worst part wasn't the money. It was that he knew the whole time he was breaking his own rules and did it anyway. So after 3 years of full-time effort, his $30,000 is worth roughly $30,000. Maybe a little less once you count the course and the 2 months he basically donated to the market learning what a bull trap is. Sam, meanwhile, hasn't looked at his account in ages. When he finally does, it's sitting around 47, 48,000. He was, by any honest accounting, completely checked out, and he's now $17,000 ahead of the guy treating this like a second job. Because here's the thing, Ryan isn't unlucky. Ryan is normal, statistically exactly where the research says he should be, and the data is not close. In Brazil, researchers tracked everyone who started day trading over a 3-year window. Of the people who stuck with it past 300 days, the committed ones, the Ryans, 97% lost money, not underperformed. Lost, about 1 in 100 made more than minimum wage doing it. In Taiwan, economists pulled the complete records of an entire stock exchange over 14 years and found that fewer than 1% of day traders could reliably earn a profit after costs. And in the United States, the most active traders, the ones doing the most, trying the hardest, underperformed the market by around 6.5 percentage points a year, every year. So when Ryan ends year 3 where he started, that's not bad luck, that's the median outcome. The activity itself is the thing costing him. Every trade has a spread, a tiny gap between the buy price and the sell price. Pay it a couple of times, no big deal. Pay it hundreds of times a year against machines that see the price move and act before the light from your screen has even finished reaching your eyes, and you're running a business whose only loyal customer is your broker, who, by the way, thinks you're doing great and really hopes you'll keep going. And that's before the cost that never shows up on any statement at all, the hours, which is where this gets genuinely brutal. Let's count them. Ryan trades 30, 40 hours a week, call it 2,000 hours a year. Over 5 years, that's somewhere between 7 and 10,000 hours of his one and only life spent staring at screens. Sam spent about 1 hour, total setting up the auto deposit. Which means that, measured by the hour, Sam is quietly the highest paid person in this entire video, and he was asleep for most of it. So let's check in at year 5. Sam's fund is around $63,000 now, and the shape of the line is changing. It's not crawling anymore, it's curving. Compounding is boring for the first few years, and then it quietly turns into a monster. The gains start generating their own gains, and Sam's money is now earning more per year than he puts in. Ryan, though, is part of a different statistic by now. Only about 15% of day traders are even still trading after 3 years. The rest quit, blew up the account, or drifted back to a normal job with a much more skeptical view of Discord servers. So if Ryan's still in the game at year 5, he's a survivor, but surviving and winning are not the same word. And it's easier to become Ryan now than it's ever been. For more than 20 years, one rule quietly protected beginners from themselves to day trade actively. You needed at least $25,000 in your account. But lately, that guardrail has been rotting away. Between offshore brokers, prop firms, and new high-leverage products, it's never been easier for a beginner to bypass the old rules and blow up an account with just a few $100s. By year 10, the two lives aren't even in the same conversation. Sam's account has crossed $116,000, he put in $54,000 of that, and the rest is compounding he did nothing to earn. He got promotions, took vacations, lived his life, and in the background his money quietly out-earned a man working full-time to beat it. Now, a day trader watching this has a fair objection, and I want to give it real weight. Because if I only trashed one side, I'd be no better than the course sellers pointing the other way. The objection is this. Sure, most day traders lose, but the best ones win. Skill is real. And, that's true. The Taiwan data did find a tiny group whose skill survived the costs. Skill exists. But here's the problem with betting your life on being in that group. Look at the professionals, not guys in their bedrooms, the actual pros, with Bloomberg terminals and research teams and economics PhDs. Every year, a scorecard called SPIVA checks how many of them beat a simple index fund. Over the last 20 years, about 92% of them lost to it. Let that land: people with a Bloomberg terminal and a research team. Losing to a fund you could set up on your phone during a bathroom break. And if you want it even blunter, Warren Buffett once bet $1 million that a plain index fund would beat a hand-picked basket of elite hedge funds over a decade. He won so decisively the other side conceded early. The index returned about 7% a year. The brilliant, expensive hedge funds returned about 2%. So when Ryan tells himself he'll be the exception, he isn't competing with other beginners, he's competing with those pros and losing to the same fund they lose to. Now let me turn this around, because index investing isn't some risk-free magic trick either. The market is brutal to sit through. In 2008, the fund Sam's money is parked in dropped 37%. More than a third of his wealth gone on paper in a matter of months. Think back to early 2020, it fell almost that fast in a matter of weeks. And we've seen plenty of those stomach-churning dips in the years since. Sam felt it too. In that crash, he opened the app for the first time in months, saw the number, and sat there with his thumb hovering over the sell button. Every instinct in his body screaming at him to get out. He didn't press it. That's the entire heroic act, a guy on his couch not pressing a button. And it was worth more than every trade Ryan ever made. Because the index only pays you that long-run average if you actually stay in your seat, and most people can't. Study after study shows the average investor badly underperforms the very fund they own, panic, selling at the bottom, and buying back at the top. They leave half the gains on the table by flinching. So Sam's edge was never intelligence. He's not smarter than Ryan. His entire edge was the ability to do nothing while his stomach screamed at him to do something. That's the whole game, and it's harder than it sounds, just in a completely different way than day trading is hard. There's one more cost quietly working against Ryan too, baked right into the law. Taxes. When Ryan wins on a trade he held for a few hours, the government calls it a short-term gain and taxes it like a paycheck, at his ordinary income rate 22-24%. Sometimes more, skimmed off every winning trade every year. When Sam finally sells, years from now, it's a long-term gain, taxed at a lower rate, often 15%. And Sam isn't paying a cent until he sells. His gains compound untouched for 20 years, while Ryan's get taxed the same April he earns them, shrinking the very pile that's supposed to be compounding. So even in the fantasy where Ryan is a winning trader, say he nets $20,000 in a great year, he hands a chunk straight to the government, he spent 2,000 hours earning it, and he carried risk Sam never touched. Run that math and his income can quietly work out to less than minimum wage per hour. And come spring, Ryan's tax return looks like a crime scene, hundreds of trades. Wash sale adjustments, a spreadsheet with its own trust issues. Sam's tax return is a Tuesday. He didn't sell anything, so there's nothing to report. The tax code is not neutral here. It quietly rewards the guy sitting still and penalizes the guy doing all the work. So let's jump to the finish line this whole video promised, year 20. Sam never became an expert. He never learned to read a chart. He just kept buying the boring fund and refusing to flinch. And his account is now sitting somewhere between $250,000 and $340,000. He put in about $78,000 of that. The other $250,000 is pure compounding, money that showed up simply because he left it alone. Ryan, 20 years in? The overwhelming odds say he stopped trading years ago, somewhere between quietly and painfully. And if he'd just put that same $30,000 into that same boring fund on day one, he'd be standing exactly where Sam is now, except with 10,000 hours of his life back. Now, does day trading ever make sense? Yes, in a few narrow situations. If you treat it as a real business with an edge you've actually tested, risking a tiny sliver per trade so variance can't wipe you out, If you're using it as training for a real career, a prop firm, a quant desk where it's a job with a paycheck, not a lottery ticket, or if you're playing with money you've genuinely decided is entertainment, a small slice you can afford to set on fire, the way some people spend on golf. Day trading isn't evil. It's just a job with a 99% washout rate that markets itself as a shortcut. And notice the one guy in this whole story who reliably gets rich, the man selling the $1,500 course. He really is making money hand over fist, just not the way he tells you. His edge isn't the market, his edge is you. But that's the real trap, and it was never day trading versus index funds at all. Ryan and Sam both thought they were answering which one makes more money. That was the wrong question the whole time. The real trap is believing the effort you put in should match the money you get out. Because in investing, that relationship is often backwards. The market doesn't hand out prizes for trying hard. It hands them out for being right and being patient, and patience looks an awful lot like laziness right up until the moment it looks like genius. If this is landing and you'd rather be around people who run the real numbers instead of chasing the loudest option, that's exactly what we're building over a school community where we go deeper on this stuff without the rocket emojis. Links in the description. Because here's what nobody selling you a course will ever say out loud. The most sophisticated money move available to a normal person, the one that beats the overwhelming majority of professionals, is to buy the whole market and refuse to touch it. It's almost insultingly simple, and that simplicity is exactly why people talk themselves out of it. It doesn't feel like enough. It doesn't feel like winning. And if you're sitting there thinking there has to be some middle path, some sane, small way to scratch the trading itch without lighting your future on fire, you're onto something. There's a version of this, a single rule I call the 5% line, where you keep the fun and the adrenaline without ever letting it touch the money that decides your future. But that's its own video, and if enough of you want it, that's the one I'll make next. For now, though, the next time someone shows you their trading screenshots or tells you index funds are for people who've given up, ask them one question. Not how much did you make? Ask how many hours did that cost you and did you count them? Because the guy who did nothing, who bought the boring fund and went back to his life, wasn't being lazy. He was being paid in the one currency day traders always forget to track, the time they never get back. Ryan spent 10 years trying to beat the market. Sam spent 10 years ignoring it. And the market quietly, patiently rewarded exactly one of them. If you want the room where we keep doing this math out loud, you know where to find us. I'll see you in the next one.